Hi, I'm Pattu from freefincal. This is my portfolio audit for 2020. As regular readers or viewers may know that I've been auditing my portfolio once a year since 2013. The archive of all the links is available in this article. And the reason why I do it is I want to showcase the benefits of goal-based investing to viewers, and I'm hoping that other people would be inspired to do the same. And I'm very happy that Suhas Bharadwaj had shared his portfolio audit of a few days ago. I have two more such audits in the pipeline that's going to be published in the coming days, and that I'm hope would inspire others, at least a few people, to look at the portfolio in the right way and not focus on returns. One of the most dramatic examples of not focusing on returns is my own retirement portfolio. That is the uh, equity mutual fund part of the retirement portfolio, the return for that. I have been investing in equity mutual funds for retirement since June 2008. And last year, that is in December 2019, the overall XIRR of the equity mutual fund portfolio, the mutual fund part alone, equity mutual fund part alone, was about 11ish%. It fell to 2.75% or so in March 2020, but now it has bounced back to about 13%. But during all this time, I never lost my financial independence status. That is my if X is my annual expenses, then my total retirement corpus was about 31x. It never fell below 31x. It was 35 36x before all this crash. Then it fell a little bit, but it only fell to about 31x. So I never lost my financial independence status, although the returns jumped up and down so dramatically. And as I had mentioned several times before, for my son's education, I had kept enough funds in fixed income for a typical, let's say, engineering type of UG. Of course, he's only 11 now, and that status also never got affected by the crash. And so it was. The reason I keep saying this is, please don't bank on returns and keep investing blindly. Always focus on the actual worth of the portfolio in terms of your future needs. If I were to take my son and put him in an engineering college today, how much is my portfolio worth? If I were to retire today, how long can I live without trying to get any other source of income? That's the kind of evaluation which is more important than any kind of return chasing exercise. So let's take a look at the numbers. Let's start with retirement. The current asset allocation is 62.6% equity, the rest is in fixed income. Within this 62% equity, 53% is equity mutual funds, and the direct equity is just 9.1%. Remember that I had talked about my direct equity returns in a separate article and video. As on date, the total return for that stock portfolio is 22.77% gains plus 1.17%. 1.17% dividend income. And that's I don't want to mix that in here. Let's talk about that later. Anyway, I will be publishing monthly updates of that stock portfolio. It was started out as a experiment, and now it's no longer an experiment because it has now grown to something significant. Now, the fixed income part, most of the fixed income, 83% of the fixed income is in NPS. The XIRR since March 2010 is 10.2%. There is a little bit of PPF in the portfolio. The NPS is standard government NPS with 15% equity and long-term gilts. Please be very careful. Some people are enamored to invest in NPS because of this kind of returns, especially long-term gilts. Don't do that. It can be extremely risky. Don't do that without understanding the risks. For example, in July 2013, the rupee crashed, and the bonds long-term gilts dropped a huge amount and my XIRR almost became half. It was like 11 and it became about 6 or so just in a couple of days. So it can be extremely risky. Don't invest without understanding. Coming to the equity mutual funds, the overall XIRR since June 2008 is 13.2%. HDFC balanced, that is HDFC hybrid equity occupies 33% with a XIRR of 12.6. Parak Parik is 42%, 43% in weight with a XIRR of 18.8%. Quantum long-term equity is 24% in weight with a XIRR of 8%. Now, many people ask why not index funds. I believe that my stock portfolio is an index portfolio. It's a low volatility, passive kind of portfolio. And as I'll show you in the graph, my portfolio has, my mutual fund portfolio, that is my equity mutual fund portfolio, has fallen less than the index in the 2020 crash. It is about 15% less volatile in terms of daily volatility when I compare it with Nifty B's now. And at 46, I appreciate that low volatility and reasonable downside protection. And maybe younger readers may not appreciate, younger viewers may not appreciate it, but that's fine. Also, the HDFC Bank has regained the top spot in the Nifty in December 2020 and dethroning Reliance for after a long time. So I believe that that should correct the market imbalance, and active funds, at least my portfolio, I hope, should do reasonably better. I don't have any kind of shiny object syndrome. If I see Nifty performing well, I don't go chase after Nifty. If I see an NFO, I don't go chase after it. My investment strategy is filled with inertia and discipline. The less I tinker with my portfolio, the better off I am. That's my philosophy, and I'm happy with that. I still believe for young people, index funds would be better, especially for those who have trouble finding the correct fund. Even if you are on the fence, whether you are undecided about choosing index funds or active funds, at the very least, I would suggest that you consider hybrid funds. Then at least for the higher expense ratio you are paying, you are guaranteed lower volatility in terms of lower standard deviation and some kind of downside protection. So my financial independence status, I don't want to share exact numbers anymore, but it's well above that 30 times my annual expenses mark, and I should be able to live the rest of my insipid life and draw an income that increases with about 6 to 7% inflation with the corpus. So that's that. So that's in place more or less. Now I have several resources for retirement planning, early retirement videos as well, so you can check that out. And this is the equity mutual fund part of the retirement portfolio, not the full retirement portfolio. I should have written this equity mutual fund part of the retirement portfolio. I think it causes some confusion. So this is just the equity mutual funds, the black line. The red line is the Nifty Bs. The green line is the Nifty Junior Bs. That is, if I had made whatever transactions I did in my retirement portfolio, buy, sell, switch, redemption, all those transactions, if I had done same amounts, same dates with the Nifty Bs ETF or Nifty Junior Bs ETF, that would have been the kind of movement. Now I have chosen the Bs because in the ETF there is some kind of small expense ratio built in, because in before January 2013 there were no index funds available. There were no direct plans available. There were no direct plans available, and therefore the expense ratio for the index fund would be higher in that period. And I don't want to use just the Nifty or the Nifty Junior, Nifty Next 50, because that expense ratio matters. Over 12 years, the expense ratio will play a huge role. So it has to be added in for some kind of reality. If you use a direct plan index fund, the expense ratio would be higher, and therefore the overall movement will be a little bit lower. And I have used the NAV of the ETFs and not the price, because if you use the price, then the fluctuations will be higher, and also the overall performance would be lower. So if you zoom this performance from January 2019 onwards, then you can see during the period when the market imbalance, where the most of the Nifty movement was governed by just a few stocks like Reliance and a couple of others on the top, that period of time the portfolio did not do well with respect to the two ETFs. But after the crash, the portfolio has recovered, and I believe that recovery would be there for a while. And I don't mind if I don't mind waiting. I mean, as I don't want to change my portfolio because there's too much of funds in each of these mutual funds, too much of amount in each of these mutual funds. It's just painful to start shifting them and so on. And if I start an index fund, it'll just be a fourth fund with a very small exposure. It will take forever for me to get significant exposure there. So it's just not worth my time. Alright, so you can also see that in this graph, you can see the Nifty Next 50, the volatility. Suddenly it zooms up and then it falls down, and now it is below my portfolio and so on. So you have to be careful with the Nifty Next 50. So for my son's education or on marriage goal, earlier they were separate, but now I have tied them all together. Now it is just 7 years left for the first withdrawal. Earlier it was 18 years. So I saw that the equity allocation was about 67%. I reduced it drastically to 55% on the 1st of December. And equity is 55% now. Overall return 11.8%. HDFC Prudence is 36% weight with 13.1% returns. Mid large cap is 38% weight with 13.6% returns. ICICI multi-asset is 26% weight with 12.5% returns. And the fixed income is just PPF in his name and my mother's name, because I use that for her tax saving as well. And there's a good chunk in ICICI equity arbitrage with about 6% returns. And gilt fund, I had posted a video why I chose it, and it's just a few days old, so there's no point talking about returns there. That's about that. The rest of it is going to be just managing the risk and making sure there's enough corpus in the portfolio. Returns don't matter. You can't buy in college education with very high returns. You need actual amount. You actually need the money in the bank. So that's the only priority from now on. Thank you for listening. If you have any questions, let me know.